Now it's my pleasure to introduce you to Casey Matthews. He's the Executive Vice President and Chief Investment Officer for UMB Bank. As an industry veteran of more than 25 years, he oversees UMB Bank's investment strategy and is responsible for the oversight of $10 billion in assets for the company. Casey earned his MBA from the University of Notre Dame after completing his bachelor's degree at the University of Minnesota. He also attended the American Bankers National Trust School at Northwestern and completed an advanced education investment management program at Harvard Business School. Today, Casey provides economic commentary on behalf of UMB as a regular contributor on Bloomberg TV and radio, CNBC television, and TheStreet.com. He also spends his time touring major cities across the US, talking to investors about the state of the economy, the banking industry, and financial markets. Please join me in welcoming Casey Matthews.
Well, as Dorothy said in The Wizard of Oz, we're not in Kansas anymore. And she adapted. And Forrest Gump said, life is like a box of chocolates. You don't know what you're going to get. And Forrest adapted. Well, good morning, everyone. I'm Casey Matthews. I'm the Chief Investment Officer for UMB. Welcome to the great adaptation, the road to recovery. You know, today we're all adapting. The way we consume, the way we work. Even Senator Kramer talked about the changes he's making and the way he conducts his work. And it all has a significant impact on the economy. So today, we'll spend 50 minutes or so talking a little bit about politics. We'll talk about this great adaptation of what's changing, how we need to change. We'll talk about the economy as it opens up. And when will we get back to a sense of normalcy, as the senator talked about? He liked normal. We'll talk about some of the stimulus out there, and the Fed has been very, very bold. One question that many people ask is, what about inflation? Will this lead to inflation? And we'll talk about that. We'll talk about other financial markets, stock market, should we buy, sell, or hold? We'll talk a little bit about some of the risks that are still out there, and then we'll really have some fun. I want to make sure we have time to field your questions. Be interesting to see how you think about things, if you think I'm all wet with my forecasts and thoughts, but that'll be a fun period. So let's talk a little bit about the election, right? So does the election matter? Well, the answer is yes on many fronts, but today I'm going to ask you to just think about, does the election matter when it comes to the economy, the fundamentals of the economy, and financial markets? And the senator kind of alluded to that. He said, you know, the fundamentals are still there. We're still going to get up in the morning and go to work. It was kind of interesting that he supported some of my thinking that I will share with you. But don't throw anything at me through the camera, because clearly elections matter on many fronts. But if I may ask you to think about the election in economic and financial market terms. So let me give you my conclusion up front. So when it comes to the economy and financial markets and politics, what's paramount is really monetary policy. And as I walk through this presentation, I will share with you empirical evidence of why would I say these things? Because the data leads me to believe these things. So one, monetary policy is paramount. I'll show you that markets go up when financial conditions are good, regardless of what's going on in Washington. And when we get to the markets, we'll talk about the stock market. And the stock market's a leading indicator. And lo and behold, that markets have performed well under either party. In over 75 years, the S&P 500 has produced an annualized rate of return of 11%. And maybe we can agree on one thing, that you look back in history, we've had good politicians and bad politicians. We've had Republicans in power and Democrats in power. And I assume that will be what the future will bring. And yet with that scenario, 11% annualized return, it tells you that the markets don't have to like your favorite candidate. They don't have to like the president or what's going on in Washington. And I'll show you the data. And then lastly, what we'll get to when we talk about the markets is most investors' investment time horizons are much longer than political time horizons. We have an election every 2 years. So maybe your favorite politician is no longer in office, and or sometimes that politician's party is not in power. So many politicians talk about my 10-year plan on this and that. Well, if they don't have the power to get things done, it just doesn't matter to the fundamentals of the economy and the markets. So let me move on. It's kind of interesting. Of course, I do a number of these presentations, and as I was putting this together, I said, you know what? I'm going to use some of the slides that I used to use before the election in this presentation after the election, because it still might be relevant. And here we are at 9:30 Central Time. I just checked the data, and lo and behold, the race is too close to call. Very interesting. But what I show you here is just the odds of who would win. And this is from Predix, so it's not Casey the loose cannon. But on top, I show you candidate Biden. On the bottom, I show you President Trump. And it's kind of interesting that one of our forecasts, we're not right on all of our forecasts, of course, but one of our forecasts was we felt this was going to be a very tight race. And that, of course, has come to fruition since we don't know the answer just yet. But it's interesting, the data was saying right in front of you that it looks like candidate Biden's going to have a landslide, he's going to win, and that is not the case. And it's also interesting what I show you is it's a little bit of a repeat perhaps, because the top pane shows you the current situation, again, the odds of who will win, and you can see candidate Biden was in the lead, the blue line in the top pane, and the orange line there is President Trump. But look at the last election going back to 2016. You saw some of the same things. Remember, Senator Clinton was way in the lead. She's going to win. And on the right-hand side of the bottom pane, you can see it flip-flopped. So just like today, it looked like candidate Biden was way in the lead, and all of a sudden the race became very, very tight. And we'll see what will happen here in the next couple of days. One of the reasons why we were suggesting it would be a tight race, because forecasting elections, we think, are relatively simple. You just need to look at two variables. And I show you the two variables here on this slide. The top pane is the presidential job approval rating. And there are a number of data points out there. This is from Real Clear Politics. You can look at Gallup, whatever you wish. And the bottom pane is just unemployment. Because, of course, unemployment is a proxy for the economy. When unemployment's going down, things are getting better. People feel good. But you can see here, if I take you back to the top pane, over on the right-hand side, the President Trump's job approval rating was actually kind of climbing out of a hole. And actually, I looked just the other day, and it moved up to 46%. So what we find is historically a president, an incumbent running for re-election, needs to get to about 50%. President Trump just didn't quite get there, leading us to believe that's going to be a pretty tight race. And then the bottom pane is unemployment, again, a proxy for economic conditions. And it's not the level. I mean, here we are at 7.9% unemployment. It's still relatively high. But you can see the trend. We know, and we'll talk more about this, we know what happened back in April, unemployment spiking to almost 15%, and then you can see the improvement. But the trend is what is important when we have a presidential election. People are feeling good, they're going back to work, and the bottom pane was in President Trump's favor. So you can see the mixed signal leads to a tight race, and exactly what we have. All right, enough about politics. So one of the common questions we get is, hey, Case, when are we going to get back to the sense of normalcy when it comes to the economy? So what I did here is I just showed you quarterly GDP going back to 2004. All of my slides, the shaded vertical areas, are periods of recession. So we kind of know what happened. If I draw your attention over to the right-hand side, there's the COVID-19 recession. We all know what happened, right? If I take you back in that gray area on the right-hand side, we all know what happened. The economy shut down in really the last 2 weeks of the first quarter. And we got a minus 5% contraction in the economy. And I want to put this all in perspective. So if you look towards the middle of the slide, in 2008, 2009, there's the Great Recession. And look at that. In the Great Recession in the fourth quarter of 2008, we had a contraction of 8.2%. A period so bad, so painful for many of us, for our businesses, for small businesses, it was deemed the Great Recession. And in the fourth quarter, we had a minus 8.2. Well, like I said, the first quarter, the economy just shut down for 2 weeks and we had a minus 5. And then we all knew it was coming with the economy shut down. There you can see on the right-hand side of the slide, in the second quarter of this year, an unprecedented contraction in the economy like we've never seen before, minus 31.4%. And it's kind of interesting because things really changed. Meaning, we would sit around the conference room table in our shop and we would debate, do you think third quarter GDP is going to be a 2.4 or maybe a 2.2? Today, do you think it's going to be 5%? Do you think it's going to be 15%? Or do you think it's going to be 30%? You can see this just unprecedented situation. Now, we just got third quarter data a week or two ago. And we saw this nice rebound, 33.1% as the economy reopened. We felt good. We were looking for a safe, familiar, and convenient way to consume. And even though part of the economy still shut down, maybe hospitality and leisure, things like that, but we saw this really nice rebound. Now remember, fun with numbers. If you were to lose 50% of your assets, you don't need to gain back 50% to get to even. You need to gain back 100%. So yes, we saw this nice recovery in the third quarter, but now the fourth quarter is in jeopardy. Because of course, part of the reason we saw the third quarter robust recovery is because of stimulus that the senator talked about. Bipartisan support, unanimous. Let's get and that's probably the right thing to do. I'll show you some data why I would say that. But lo and behold, it supported the economy. But now, of course, Congress is on recess until November 9th. We don't have the next stimulus plan that we need. And we need another $2 trillion to get to 2 to 4% GDP growth. Well, we don't have that just yet. So the question is the fourth quarter GDP going to be 1%, 2%? Will it be a double dip recession? I don't think it'll be a double dip recession. I'll tell you why momentarily. But nevertheless, we're in the camp. It's probably going to be about 3% or so. But you can see on the right-hand side, what comes next is you saw this contraction, you saw the recovery, and now what? We had the Great Recession in 2008. We had the Great Adaptation this year in 2020. And now what we get? The Great Plateau. Because like I said, if you lose 50% of your money, you don't need to gain 50% back. You need 100. And that's not coming just yet. So when will we get back to a sense of normalcy? I like to just put numbers, a bunch of bankers, maybe you like spreadsheets and numbers. So to answer that question, we just looked at actual GDP. So I have three rows here. And over on the left-hand side, you have actual GDP, you have the quarterly GDP rate change, and then you have the percent below the peak. So if I draw your attention to the left-hand side there, I circle it, fourth quarter 2019, the good old days, right? We had, call it $19.3 trillion of economic activity. And then of course, we know first quarter, the economy shut down in the last 2 weeks, causing a 5% contraction. And then look in red, third quarter GDP, the significant contraction, $17.3 trillion of economic activity. And then you can see kind of our forecast out to the right-hand side. I think that's in light blue. You can see that we even suggest that maybe we see a 4% GDP rate in the fourth quarter, which is in jeopardy. The risk is to the downside right now without more stimulus. I do think we'll get more stimulus. But then you can see that you get back to the sense of normalcy where you get back to 2 or 3% GDP. Way on the right-hand side, it takes you to the fourth quarter of 2021. 2 years. 2 years of this. And then we're going to talk about COVID-19 and these resurgence of cases. I'm not the expert to opine on that, but any setbacks we have on a vaccine, all of a sudden, maybe it's the recovery, we get back to normal, $19.3 trillion of economic activity in 2022. We'll have to see. Now we know the culprit. Right, like I said, I don't want to spend too much time on COVID. We all know what happened. And it's interesting, I just show you a couple of states. Got New York, Florida, Wisconsin, Indiana. We went through that bubble in the springtime, but look on the right-hand side of the screen. You can watch the local news, and I'm even in a hotspot. I work in Missouri and I live in Kansas. And we have all these spiking cases. And that that's important because the question will be, will it shake confidence? Will we have shutdowns? You probably have witnessed on the news that you look at Germany, France, the UK now shutting down their economies again, or parts of their economy. We know that hinders economic activity. Will that flow into the United States? We just don't know. When are we going to see a vaccine? We just don't know yet. But I think we did a polling question. Amy did the polling question. Let's talk about the answer right now. So I think, Amy, can you share the answer? So remember the question, once the CDC approves COVID-19 vaccine, when will you get it? Well, it looks like 26% of you right away within the first 3 months. Another third, call it 3 to 6 months, but the vast majority are going to wait. And this is about the fourth or fifth time I did this poll. I did it in our office months ago. One person said, I'm going to take it right away. 49 others in the investment group said, I'm going to wait at least 6 months, because typically it takes 10 years to develop a vaccine. All right. So what we do know is it's not so much the cases anymore, it's really the hospitalization and deaths. So you probably already know that, but this chart just verifies that you get spiking cases, and you know what happens after that. In about 2 or 3 weeks, you get more hospitalizations and you get more deaths. So way on the right-hand side of the screen, I just already showed you some data. We know we got spiking cases around the world. Masks have become political. But we got cases going up, and even here in Kansas City on the news, they talk about they need to turn away some patients, COVID patients, from certain hospitals because they're at capacity. And that's important because when you and I don't feel safe to do some of these elective surgeries, if I need a hip replacement, that's a very profitable procedure for a hospital. And if I'm not going in and they shut down all those units, that's problematic to that sector of the economy. So let's move on and look at some of the data. So maybe a little bit of fun here. Hopefully some of you recognize this image. This is from another movie. This is actually The Field of Dreams. Maybe you remember that film. It was if these people built a baseball diamond in the middle of a cornfield, these historic players would come out and they will come and play. It's a fun little movie if you haven't seen it. But I thought, boy, that's perfect to describe the economy. If you open it, will they come? Do we feel safe? Is it convenient and familiar to consume? So let's look at the data. So first, let's look at the unemployment, the labor picture. I show you 2 data points. The top pane is headline unemployment, and the bottom pane is initial unemployment claims. Now, initial unemployment claims is important because we get the data every Thursday morning, and it gives us clues to what might happen to the top pane. So let's take a look. I'll draw your attention to the top pane, please. Unemployment rate. We all know what happened, right? Way on the right-hand side of the screen, we had this very unique recession, not caused by irrational exuberance or inflation or excess. It was caused by this nasty virus. And you can see what happened to unemployment. Back in April, we had almost 15% unemployment, and it's come down nicely from 15%, 7.9%. But I like to make observations when I look at this data. And if I draw your attention to the 2008, 2009 gray area, the Great Recession, again, so terrible, labeled the Great Recession, we got to 10%. So there's some light at the end of the tunnel. But we're not out of the tunnel yet. We're at 7.8% unemployment. And back in the Great Recession, it was 10, but it's improving. Now, initial unemployment claims kind of tells me the same picture, that unemployment's not coming down to 3.5% pre-crisis level anytime soon. Because again, bottom pane, look at the right-hand side, 751,000 Americans a couple weeks ago filed for initial unemployment benefits. Well, I thought we're getting out of this thing. 751,000. Look at the 2008, 2009 Great Recession. The peak was 665,000. And we're 100,000 Americans a week, more than that, filing for unemployment. So I do think unemployment will come down, light at the end of the tunnel, but it's going to take some time to get down to that pre-crisis level. Now, one of the things that was confusing for everyone, including the Bureau of Labor Statistics, the BLS, because the system was inundated. When you have millions of Americans filing for unemployment, we have an antiquated system, and never before had we had so many people. The BLS came out and said, yeah, our numbers could be a little off. And here's why. So here's what I show you is the percent of unemployed that are temporarily laid off, that is blue, and then permanently laid off in green. And what's interesting as you kind of look at this chart, typically in front of those gray areas of recessions, typically what happens when we see the economy slowing down, whether it's our banks, whether it's small business, in green, we permanently lay off people. It's no fun. We got to protect our margins, especially if you're a publicly traded company, and you protect your business. What's interesting is way over on the right-hand side, it was so unique. The senator talked about these stimulus programs, which we support, we agree with, but it was confusing in that a lot of people were laid off, but their bosses said, hey, you're temporarily laid off. So I'm going to pay you. You don't need to come to work, and maybe a bit of nirvana. And I don't mean to make light of this, but it was like, oh, you're going to pay me. I don't got to come in, and the golf courses are open, and I'm temporarily laid off. So you're going to call me back, right? And it's maybe a little hard to see, but you can see that spiking blue line that 80% of the people laid off were told you're temporarily laid off. And that's changed. And we knew that was going to change. And you can see that blue line coming down and the green line going up. And right there, my little indicators, you can see really they're both at, call it 36%. And what's going to happen, we think, is just that green line will continue to go up and that blue line is going to come down. Kind of confuses some of the numbers. So how do we feel about this? Maybe some light at the end of the tunnel at the labor market, but how do you and I feel about this? Well, let's look at confidence. So I show you 3 confidence indicators on the slide here. The top pane is you and me, consumer confidence. That's important because you and I represent almost 70% of economic activity. Then I show you the NFIB, National Federation of Independent Businesses, small business optimism. How does small business feel? And just so you know, this is really small business. NFIB data, typically their surveys are businesses with an average of 10 employees. As you can see, small business. Then the bottom, it's big business. That's Coca-Cola and IBM and CEOs of that nature. So let me draw your attention to the top pane, please. Consumer confidence, how do we feel? You know, we don't feel that bad about things because, again, there are a couple observations. So way on the right-hand side, you see what happened, a waterfall event as the economy shut down. But one observation is, if you compare it to the Great Recession was a little bit of death by 1,000 cuts. The economy just kept slowing down. And you can see that right in the middle of the page in the top pane where confidence just kind of went down for, 2 years. But we had a waterfall event back in April, but it was nowhere near the level that we saw in the Great Recession. And then just recently, because of the labor market, because of the stock market, because of home prices, there are a number of issues making us feel good. We can go get our coffee at Starbucks in a safe, convenient, familiar environment through their takeout, their drive-throughs. All of a sudden, we're starting to see confidence bump up, as you see on the right-hand side. And actually last month, confidence had one of the biggest gains that we saw in 17 years. So we're starting to feel good about things, the light at the end of the tunnel. Small business is exactly the same thing. And big business on the bottom pane, it's kind of interesting because you can see in about 2018, big business confidence started to wane. The reason for that is, you may recall, that's when President Trump signed the America First policies, and we had tariffs, talk about protectionism, confusing custom regulations, things like that. And if you were a CEO doing business in 200 countries, your confidence might be shaken a little bit as well. So it went down starting in 2018, but look at the nice rebound. One of the issues with COVID is COVID really hurt the small business and small businesses, but big business seemed to power through it okay. And that's why you can see, especially companies like Zoom that we're using today, or Clorox, or Amazon, right? There are a number of big businesses that actually flourished in this environment, and you see some of that in the CEO confidence data. Now, some of this data comes out monthly, quarterly. So what we like to do is maybe it's take a lesson from, I think it was President Reagan, who said, trust but verify. So we have found data which is high frequency data. And there's a number of these indicators out there. So I just show you a handful of them, and I'll start with the upper left. Here's data coming from the Dallas Fed, which is the mobility and engagement indicator. Maybe a little scary, so there's a lot of people watching what we do every day. And you can see here that what you see in the upper left, you know, when the economy opened up, it was don't fence me in, we want to get out, and you saw this mobility index go up, but look at the great plateau after that. And you see the same thing below that, retail traffic. We wanted to go out. We were sick of sitting in our home office. We have, you know, pandemic fatigue, we have webinar fatigue, and we just wanted to get out and do things. And over on the upper right, open table. And it's open table dinner reservations. Well, that's going to trend downward, because here I'm talking to people, and I'm in Kansas City, a lot of people in Iowa, North Dakota, wherever, Minnesota. I went to school in Minnesota. It's probably a little chilly to have dinner outside tonight. So you can just see what's going to happen with some of that businesses. And then airline traffic, even though there's no evidence of anyone catching COVID in an airplane, even though we think about that tube full of nasty air, they got their HEPA filters, whatever, and no, not many people are going to Disney World or whatever, or even travel, as the senator talked about. So there's light at the end of the tunnel, but it's shaping up to be a potential great plateau, my next article. Now, what kind of, we know kind of what supported the economy. Like I said, there's light at the end of the tunnel, and it was really a lot of government assistance. So let me show you some income data. So again, this is data from the Congressional Budget Office. It's not Casey Loose Cannon. But what's interesting is the senator talked about the CARES Act and all this money going to people, which was the right thing to do to avoid a recession, pardon me, a depression. And you see in the top pane, you had personal income actually go up in this global pandemic. And I'll tell you why momentarily. It's starting to come down here because we need the next stimulus package. But look at the bottom pane. Without any stimulus, you might have had the next depression. You can see how terrible it would have been. Now, we have all these programs that helped consumers. And I actually wrote an article called The Potential Household Fiscal Cliff. Meaning the senator talked about all the stimulus program, which was the right thing to do. But now a lot of these expire. Some have already expired. Of course, the enhanced unemployment benefit of $600 a week expired back in July. Now we're starting to see all these programs. I don't know if you can read it that well, but you know, we had forbearance on mortgages, right? Eviction forbearance, all these things that were pushed out that are starting to expire. So now the question is, like I mentioned, will the fourth quarter be in jeopardy? Will the first quarter GDP be in jeopardy? Without some of these extended stimulus programs, yeah, I think it will be in jeopardy. But we're confident we'll get another stimulus program sometime in November. Now, you saw my personal income chart. Why did we have that big spike? Because this is a chart not too pretty, sorry about that, but I just grabbed it from a University of Chicago study where they said, this is what happens with consumption when you get laid off. And you can, hopefully you can pick out my thin blue line at 0. That's when you get laid off. So prior to that, you're spending all of your income over that 100%, right? Maybe even more than that because you're borrowing some money, whatever. Then all of a sudden you see the writing on the wall. You start to see layoffs. The boss is talking about, oh, business is tough. I don't know what we're going to do. Our margins are at risk here. So you kind of control your spending. And all of a sudden at 0, you get laid off and you're spending about 95% of prior consumption. Now this study went 26 weeks. That was the normal unemployment benefit. And lo and behold, you can see on this chart in my dashed line, vertical line, after 26 weeks, you're down to about 80% of prior consumption. And now, of course, we have extended unemployment, not 39 weeks. But the question is, if all this expires, look what happens the longer you're unemployed. You get down to maybe 70% of consumption. That's why I say some of the future quarter GDPs would be in jeopardy if we don't see more stimulus. I thought this was fun. Who consumes? So what I show you here is demographics by consumption by age group. And it goes back on the left-hand side, those that consumed in 1990 and then on the right-hand side, 2020. And the blue bar is those over the age of 65, what percent of total consumption is done by that demographics? And then the orange bar is over the age of 55, what is their percent share of total US consumption? So you can see in 1990 that, okay, it was, the 65-year-olds were, call it whatever, 12, 13% of consumption, and way over on the right-hand side, 2020, they're now 20%. Part of that is the baby boomer bubble working its way through the economy. But the point is, I wanted to put this in here because when this pandemic started, it was a little bit of, it really had a negative impact on the elderly. And then maybe we learn more, maybe it affects younger people, whatever. You can get expert opinion from others rather than me. But my point is, if this thing lingers on and it negatively impacts elderly, and I'm in the orange bar, I'm older than 55, will it affect my consumption? And that's important because when 40% of total consumption is done by people like you and me over the age of 55, well, guess what? We're not spending $25,000 to go to Disney World, or grandma and grandpa's not taking the extended family on that vacation. And that will hinder consumption and GDP activity. So this was kind of fun. And it was kind of fun with your vaccine question that the vast majority, almost 50% of you, are going to wait to get a vaccine. But this is a rhetorical question, of course. It's kind of interesting. When will you return to a sense of normalcy and do some of these things? Maybe we start at the bottom of this page. When will we go to the office? Well, I'm still working from home. They actually built this little studio for me to do these presentations. I'm in the office today, but I'm leaving after this. Our office is starting to open up, but we can get everything done at home. And you can work your way up the list. When will you go to the movies? Well, you saw that some of the movie chains are going bankrupt. When will you go to public transit? When will you go to a gym? And I just talked about Europe's shutting down the gyms again. When will you take a cruise? Well, I don't think we can go on cruises just yet. When will you fly on a plane? Even the senator talked about some things will permanently change, maybe the number of flights we take. Now, I alluded to this. Did the government do the right thing? And Senator Kramer talked about bipartisan support, unanimously supporting $2 trillion of support. And we would say, yeah, that's the right thing to do. So this is a thing called the fiscal multiplier. And it's created by the Congressional Budget Office. So again, not Casey the loose cannon. But what it does is the multiplier means when the government spends $1 on stimulus, how much economic activity do we get? Do we get $1.50? That would be good. If we got 50 cents after $1 of stimulus, that would be bad. So what this chart shows you on the bottom is all kinds of fiscal stimulus initiatives. Way over on the left-hand side, that's direct purchases of goods and services. That's like when the government has an infrastructure bill and they buy concrete and steel bar and put people to work, roads and bridges, things like that. The blue bar, it depends. The multiplier depends on the environment. It could be as high as 2.5 times. Government spends $1, we get $2.50 in economic activity. You can see it could be as low as 50 cents. But when you look at the number of initiatives on the left-hand side, that's what the government did. Transfer payments to state and local governments, transfer payments to individuals. And at least it has the highest potential to stimulate the economy. What's interesting over on the right-hand side, guess what? A lot of tax breaks, especially for the high wage earners, do nothing. It never even gets to 1. When you think about that, when wealthy people get a tax break, their marginal propensity to spend is 0. Because those wealthy people, if they go on vacation, they already have a deluxe hotel or stateroom in the cruise, right? They can afford it. But when lower income people get a stimulus, get $1, they have 100% marginal propensity to spend because they need to. So whether it's upgrading their vacation or buying more protein, whatever the case might be, it goes into the economy. So yes, the government did the right thing. There's a time to deal with the deficit and the debt, and there's a time to support the economy and not go into a depression. But here's some of the confusing data out there. So we had all these programs out there All these Fed programs that the senator talked about. And what's interesting is we don't have clear data just yet because of all the forbearance that went on. Look at all these loan programs. Over on the left-hand side, automobile loans, credit cards, mortgages, other unsecured debt. Here's where we are with 90-day delinquencies. And if I draw your attention to the right-hand side, a year ago, August 2019, here was the 90-day delinquency rate. And then over, you can see August on the left-hand side. So we went through a global pandemic. We had millions of people filing for unemployment benefits. All kinds of people, 15% unemployed. Small businesses dropping out of the economy. And yet, if you look at the mortgage line, mortgage 90-day delinquencies went down. Well, why would they go up when they're all in forbearance or modification? What happens when stimulus stops? What happens when they have to pay the mortgage? So you can see why I would suggest some of the future economic data is in jeopardy. Let's talk a little bit about manufacturing. Manufacturing is important because it's very cyclical. It's a good cyclical indicator, but yet it's a small part of our economy. But I wanted to show you first China, and this is the ISM Purchasing Manufacturers Index. The way this works is when the line is above 50, it tells you the economy is expanding. When it's below 50, it's contracting. Remember, it's a diffusion index. So if the economy tanks, then you get 50. It's still down here tanking. You need to be positive to slowly grow back to a sense of normalcy. In China, over on the right-hand side, you can see the contraction, and then all of a sudden we're above 50. So it is climbing back slowly. Look at the middle pane. There's US manufacturing. Same thing. We just got new data last week. A little bit better. We had that great contraction there. You can see in the beginning of the year. And all of a sudden, we're up to 59.3. So instead of just no change at 50, we're seeing some significant change in manufacturing. And then look at services. Remember, manufacturing is only something like 11% of GDP. But services, banking services, financial services, accounting services, all those things, healthcare services, almost 50% of our economy. On the bottom pane, you can see, hey, at 57.8, again, we saw the contraction, maybe not as severe as China's manufacturing, because remember, it might be a little bit easier to close down an economy under a dictatorship than a democracy, right? When China says we're closed under a dictatorship, you're closed. Here in the United States, a little bit different. But nevertheless, light at the end of the tunnel. Let's move on to some of these Fed programs. Now, it's interesting. I don't know if we have any Trekkies out there, Star Trek fans, but our director of research, Eric Kelly, he said something to me months ago. He said, Case, the Fed has boldly gone where no Fed's gone before. And I was like, wait a minute, isn't it like the opening line to Star Trek? Well, that's exactly what the Fed did and all central bankers did around the world. So we had unprecedented deficit spending. What I show you here is the stimulus as a percent of GDP, the green bar from the Great Recession. Remember, we had a synchronized global recession. And then the dark line there is today, the stimulus as a percent of GDP. You can pick out the US starting on the left-hand side, unprecedented spending, but everyone else pretty much was in the same camp. Let's get through this. Let's get out of this. We might have some new problems and we'll deal with it later. So here's what happened with money supply. So it's interesting, and this kind of is leading into our inflation question that you might be thinking about. What's interesting, the blue line is money supply. The government just flooded the market with all this money. Where did it go? Well, the red line is the savings rate. Maybe some good news, even though because there was so much more income, as I showed you from the University of Chicago study, than pre-crisis income. A lot of people saved that. The savings rate went up almost 30%. And that's good news because now they're using that savings to support the fourth quarter as 7.9% remain unemployed. And that's why I mentioned I don't think we'll have a double dip recession, at least in the fourth quarter, because of these savings, because of the astute people out there that saved a lot of that extra income. Now, some of you might be saying, well, because that should lead to inflation, right? Let's talk about it. It depends where the money goes. So here's kind of our conclusion. that I don't think we're going to have threatening inflation, at least in the next 12 months. And here's why. I just showed you money supply growth, right? But what's missing is the change of hands, the velocity of money. So even, I'll show you momentarily, even in the Great Recession, we had all this stimulus. Where'd it go? At that time, we had a financial crisis and it went into the bank coffers. And it sat there. Not many people came to get a loan. So people didn't go out and buy a car. They didn't buy a new refrigerator, et cetera, et cetera. So we have this lack of velocity. And when you have the change of hands, money changing hands, that leads to inflation. If it goes into savings or the bank coffers, it's just money supply growth. Also, the output gap, and that is the difference between the potential our economy can do and actual. And then we already talked about the labor market and the slack we have there at 7.9%. Many of us aren't running into our boss's office and saying, I had to go downtown and do this webinar. I should get a raise. No, I'm very thankful to have a job, like many of us. And then the Federal Reserve, of course, their messaging is really, I'm okay having 2% inflation. I'm okay having the economy run hot. And they're really focused now on maximizing employment, and that might be the NAIRU rate, maybe 4.5%. Well, as we just went through some of this data, we're probably a long ways away. All right, so here's money supply growth, which I already showed you, but it's a little bit longer chart. What's interesting here is my green circles. Look, we've had money supply growth over 10% historically, right? And let me just drop and look where we are on the right-hand side. Lo and behold, we're at 30% in this crisis. But I drop in inflation, the red line. Lo and behold, every time my green circles there, those areas, back in late 90s, we had money supply growth way up at 12, 15%, and inflation doubled. Same thing in the Great Recession. We had inflation double for a short period of time. But then ever since the Great Recession, inflation kind of bounced around and really averaged less than 2%. And here we are today, way on the right-hand side, you can see CPI, Consumer Price Index, is at 1.4%. Why? Because no velocity of money. But here's another reason why no inflation. This is the output gap on the top pane, and then the unemployment rate, which we already studied on the bottom pane. But that output gap is, like I said, what is our potential for our economy and what is our actual? When we have this gap, it's hard to get price points. It's hard to pass along price increases. And that's exactly what's going on there. So you can see over on the right-hand side, our output gap is significant. We're getting negative output gap. And we already talked about the slack in the labor market. But let me just drop on this pane, on the top pane, inflation. So again, look at my circles that typically back to the late 1990s, early 2000s, the output gap was negative. And look at inflation going down. Same thing in the Great Recession. So the question is, there's all these factors, all these layers that I don't think we're going to have threatening inflation, at least for 12, maybe even 24 months. Now, I kind of mentioned early on that monetary and fiscal policy were paramount when it came to politics and really driving the economy. Let me show you the empirical evidence there. So this is just a financial conditions index. There's all kinds out there, but really it factors in interest rates, the availability of credit, things like that. And when the line's going down, conditions are softening. We can easily get money, credits available to us, and interest rates are low. So when the line's going down, conditions are softening and improving. So let me just overlay the S&P 500 performance on this chart. So you can see my blue indicator arrows that when the blue line's going down, easing conditions. And look at the stock market. Every time that blue arrow's going down, look what happens to the stock market, regardless of what's happening in Washington. So this is the data. You can just see these periods where when financial conditions are improving, the market does well, that drives economic conditions, and it really doesn't care what's going on in Washington and all the bickering that's happening at the time. Okay, so I'm on time here. I want to make sure I got time for questions. So let's just talk about the equity markets real quick. It was interesting. It was kind of an interesting stock market because we all talked about the shape of the recovery? Was it V-shaped, K-shaped, W, square root, whatever? And I'll show you in a minute, the stock market clearly was a V-shaped recovery, but I just thought it'd be fun to look at other debacles in the stock markets. The top pane is 1987. We had this big debacle in the stock market, and typically what you get is a consolidation period. You get these kind of false positives where you can see in the top pane after the 32% debacle, you do have like 15% recoveries, nice recoveries, but you're kind of wobbling along for quite some time before you get everything worked out. Now, the bottom pane is the Great Recession. I think I mentioned, death by 1,000 cuts, where you had all these head fakes. The market was going down and down and down, but along the way, you had these almost 20% recoveries. Oh my God, the market's up 20%. We got to do something. And then next month, the market's still lower. But it took some time, is the point, to recover. Well, here's what happened in this crisis, where we had this debacle, stock market off 32%. And almost there was no chance to get back in, right? It just a V-shaped recovery. The reason is the stock market didn't care what was going on in Washington, as we talked about. What it cared about is, are we going to see a recovery, an economic recovery? The answer was yes. Didn't matter when or what magnitude. And as I mentioned again, what's paramount is fiscal and monetary stimulus. The Fed came out and said, we're here to support markets and keep interest rates low into perpetuity. That's a perfect recipe for stocks moving higher. That's what we saw. So I said I'd give you some data on, does the election matter when it comes to the stock market? Here's the data. This goes back to 1996, and you can see the president, and who was what political party was in power. And lo and behold, look at that. President Clinton, market went up. President Bush got in the office and went into a recession. And I feel, I'm not political at all, but I feel the presidents take undue credit for recoveries and job growth, just like the presidents receive undue criticism when we go into recessions. They're not responsible for either. But anyway, you can see markets went down under President Bush, then they went up, and went down under President Obama, then they went up. You can see my point. Market doesn't care what's going on in Washington. And it's kind of interesting. You can see my little dialogue back there. I mentioned that over the past 75 years, the stock market had 11% annualized rate of return. I was challenged on that. I love creating a collegial environment in our research department. And you may recall I mentioned that investors' time horizons are longer than political time horizons. So I was challenged on that, which I welcome. And I said, Case, who has a 75-year time horizon? I said, foundations, endowments, pensions. I said, okay, but how many individuals? I said, yeah, you're right. I said, let's go rerun the data. How about 30 years, right? We're telling people at a young age, at 30 years old, 40 years old, invest in your 401k, et cetera, et cetera. So let's use 30 years. All right, fair. The number's 10.5% annualized rate of return over the past 30 years. Okay, so we can move on here. One of the reasons why the stock market went up is because of the Fed. And there's an old adage on Wall Street that says, don't fight the Fed. And that's exactly what you see here. The bottom pane is central banks. That when the line's going up, central bankers are easing conditions. They're lowering interest rates, okay? And the top is just a global stock market. But you can pick out, hopefully, my orange circle back in early 2000. All central banks were lowering interest rates. And look at my orange circle in the top, probably a pretty good time to buy stocks. And then look at the Great Recession. All banks, central banks, lowering interest rates, stimulating their economies. Looks like a pretty good time to buy stocks. We can see on the right-hand side, all central banks stimulating. It looked like it was a pretty good time to buy stocks. Now, here's some data on contested elections. I'll go through this real quick to get to questions, but we did have a contested election back in 2000. It's interesting. This is myopic. This is just 2 months worth of data and the market was going down. But let me look at a bigger picture. It was the economy. The economy was getting soft. We were headed into a recession in late 2000, 2001, and the stock market was going down. And then all of a sudden we got through that. So again, hopefully some evidence to support my earlier comments about politics. Now, I put this in here, some of the aftershocks, and that is just I made this slide, our team made this slide months and months ago, and I haven't changed it because after we went through the pandemic, we said, we kind of, right initially when we had the pandemic, we said, what are the risks out there? And we said, well, probably this will change 3 months from now. And we looked at it 3 months from the beginning of the pandemic, and we said, well, maybe it'll change 6 months from now. And we look at it 6 months after that. And these things are still out there. How does this economy reopen? How do we support small businesses? There's still this fight about masks and the virus. Is it political? Is it science? When will we have confidence to come back and support the economy? The second wave of COVID, oil at less than $40 a barrel puts a risk to a lot of our southern states in Oklahoma and Texas. The debt, there's all kinds of debt, not only government debt, but how about corporate debt? And maybe to some degree, if interest rates are at zero, I can have millions of dollars of debt because it's zero. My interest payment's nothing. I'm being a little silly there, but maybe it's not going to matter. And here we are still, I put on here, the presidential election created some risk, and maybe it still creates some risk. So it's interesting how 9 months ago we created a slide, and some of these risks are still out there. And some things will change. There'll be unintended consequences. Deglobalization, that's a serious threat to our economy. Who will pay for all this? The moral hazard, there's an incentive not to work. There's an incentive to take risks in businesses because the Fed will support you and will have interest rates low. And we still have trade tensions. When will that be back in the news? Nothing changed there with all these tariffs and thoughts about protectionism, et cetera, et cetera. So here's our forecast, and then I'll open up for questions. So on the right-hand side here, you can see we saw a nice recovery in the third quarter. We'll probably see a continuation of that, somewhere between 2 and 4% in fourth quarter GDP, but we'll still have a contraction of 3.5% for 2020 economic data. Unemployment probably will still come down. Fed's not going to do anything, and the market's going to be in this trading range to some degree. Even though the stock market the last 3 days tells you everything's going to be fine because of Senator Cramer's comments that our four founders said, maybe with the checks and balances, let's make sure no one can re-engineer the economy swiftly. And you get a little bit of gridlock, and the markets are okay with that. And you can see our forecast for next year, a continued gradual improvement. So that is my prepared remarks. I hope it made sense to you, but maybe we can open it up for questions and see if you think I'm all wet or how you feel about things.
All right, Casey. So we do, first question we have is actually on cryptocurrency. Where do you see cryptocurrencies heading? Is UMB looking to add cryptocurrencies to their customers' portfolios?
I think cryptocurrencies are real. They're going to be part of the economy. It's still kind of odd to think about how you value like Bitcoin. There's some speculation out there, people trading it, things like that. But I think it's real. I think it'll continue to grow how we process payments, how we pay for things, et cetera, et cetera. We have not done much in cryptocurrencies just because it's very difficult to trade. You get a key. I can't hold it in your account. If I buy it, I can't even buy it for you. But if I recommend it to you, you hold it. You hold this key, and you know what? If you forgot your code, bye-bye. So someday I think we will invest in cryptocurrencies or use cryptocurrencies, but I still think it's in its infancy stage. And one thing that I believe in is I don't have to get all of the great ideas out there to make my clients successful. I just need some of them. So with cryptocurrencies, there's a lot of speculation out there. A lot of people lost a lot of money in Bitcoin. A few of them made a lot of money. So we're just not in that arena at this time.
All right, and then just maybe another question to follow up on interest rates. Where do you see the potential for maybe negative interest rates in the United States?
We do not see that happening at this time. Like I said, the title of this presentation, The Road to Recovery, we're starting to see some traction in economic activity. So I don't think there's a need for negative interest rates. And we have great case studies around the world. Many countries are ahead of us using negative interest rates. And what you're hearing now is they're kind of a failed experiment. You had unintended consequences. They didn't stimulate their economy. So it would be odd where the Fed still has some levers to pull, maybe like the Wizard of Oz, the man behind the curtain. They can pull all kinds of levers with reserve requirements and other things before they get to negative interest rates. So I don't think there's a need for negative interest rates, nor do I see that it being a successful solution in this situation.
So I think what we'll go ahead and do is we'll go ahead and wrap things up today. Again, I want to send special thank you to Senator Kramer for speaking to us today, and he had a lot of really good insight, and sounds like he needs a lot of your help, from the community bank. So I encourage you to reach out and give him advice and feedback. Even if you're not in North Dakota, I encourage you to reach out. He seems like he really wants to know kind of what's going on in the banking world. And a special thank you to Casey Matthews here for that update. Appreciate that. So kind of want to wrap things up. Again, thank you everyone for attending today, our series 4 of our 5. And speaking of 5, that will be tomorrow at 10 a.m. Central. I have the honor of moderating the regulatory panel, which will be made up of James LaPierre from the FDIC, Christine Gaffney from the Federal Reserve, and Ben Rudolph from the OCC. We'll have a lot of good information for you community bankers out there about, I'm sure there'll be questions on recent safety and soundness exams and and then specific to probably on the CARES Act and what impact that has to deferrals and things like that. So I encourage you to attend that tomorrow. And then after, that'll be an hour and a half. And then our hour and a half after that, we'll have some local regulators that will be speaking as well as there'll be a number of different hot topics for community banks. So we'll have a total of 3 hours tomorrow, and that'll be our 5th and last segment for our bankers seminar for this year. So we hope that you encourage maybe your directors or someone else to attend tomorrow. Really good information from our regulators. As Senator Kramer said, you got to keep up your contact with the regulators. So it's important that you attend that for tomorrow. So thank you again to Senator Kramer and Casey Matthews, and thank you to everyone else for joining us today. We'll see you tomorrow. Have a great rest of your day.